All right, everybody, welcome back for another deep dive.
Yeah, happy to be here.
Glad to have you here as always.
Always ready to dig into some interesting stuff.
Yeah, and we definitely have something interesting to dig into today, that's for sure.
Oh, yeah, color me intrigued. What are we diving into?
So today we're taking a look at Zoom,
Zoom, like the video conferencing platform.
the one and only.
Huh, interesting. They were like the poster child for the pandemic, weren't they? Everyone was using Zoom.
It was like you couldn't escape it.
Yeah, seriously. What's the story with them now? I haven't really heard much about Zoom lately.
Well, that's kind of the point of today's deep dive. Their most recent quarterly report has some folks a little bit spooked, to say the least.
Oh, is that so? Spooked how? Like, did their servers crash or something?
Worse, their stock took a pretty big hit, like a 10% nosedive.
Whoa, 10%. That's got to be rough for them. What happened?
So let's break it down, shall we?
Let's do it.
So our main source today is this article, and the title pretty much sums it up. Zoom shares plunge 10% on sluggish growth recovery and tepid outlook.
Oof, that doesn't sound good. Sluggish growth and tepid outlook. Those are fighting words on Wall Street.
For real. So let's get into the nitty-gritty. The report shows that they had adjusted earnings per share of $1.38 times.
Okay, that's not bad, right? Earnings per share is a good thing.
Right, and their revenue grew year over year by 3.6%.
3.6%. Not stellar, but not terrible either, I guess.
And they pulled in a total revenue of $1.18 billion.
Okay, so like billion with a B. That's got to count for something, right?
You'd think so. But here's the thing. Those numbers might look decent on the surface, and some even beat what analysts were predicting.
But there's always a but, isn't there?
Always, right. The problem isn't so much the numbers themselves, but more what they represent compared to where Zoom was during, peak pandemic.
Ah, I see. Like, they're not the darlings of the stock market that they used to be. So even though the numbers are okay, they're not growing at the crazy rate they were before.
Exactly. Investors are basically like, what have you done for me lately? It's all about that upward trajectory.
I get it. Wall Street wants to see that hockey stick growth curve, and Zoom's probably looking a little more like a gentle slope these days.
Makes sense. And to add to that anxiety, there's this other detail in the report that's got people whispering in the corners.
Oh, do tell. I love a good financial mystery. Spill the tea?
So there's this analyst, Mark Murphy from JP Morgan, and he called the recovery muted. He also pointed to a decrease in what's called deferred income as a red flag for investors.
Deferred income. That sounds a little technical. Can we translate that into, like, normal human speak?
Yeah, for sure. Imagine you sign up for a gym membership.
Okay, I'm following. Getting those New Year's resolutions ready.
And you pay for a whole year up front.
A whole shebang. Gotta commit.
Now, the gym doesn't actually record all that money as income immediately. They spread it out over the year as you actually use the gym. So each month, they recognize a portion of that upfront payment as earned income.
Okay, I'm with you. Spread it out as they provide the service. Makes sense.
Right. So that's deferred income money they've received but haven't fully earned yet.
Yeah.
And when that starts decreasing, it suggests that future sales might be weakening.
Ah, now it clicks. So it's not just about how Zoom is doing right now. It's a potential sign that things might get tougher down the road.
Exactly. And if you were an investor who jumped on the Zoom train back when it was skyrocketing, this would definitely have you sweating a bit, right?
Oh, yeah, no doubt. It'd be like watching your rocket ship slowly start to sputter.
Right. And the crazy thing is, this isn't just a Zoom problem.
Oh, tell me more.
The whole collaboration software sector is feeling the heat as the world figures out this whole hybrid work situation.
Yeah, it's like the pandemic was this huge wave that lifted all the boats, and now the tide is going out. We're about to see who is swimming naked, if you know what I mean.
That's one way to put it.
But wait, there's got to be more to the story, right?
Oh, absolutely. There's a twist. Even after this big stock drop, Zoom, which is now calling themselves Zoom Communications, by the way.
Oh, little rebrand never hurt anyone.
Right. Well, they're still trading at 12 times enterprise value to expected free cash flow.
Hold on, can we pump the brakes for a sec? Enterprise value to expected free cash flow. That sounds like something straight out of a finance textbook. Can you break that down for us normal folks?
Okay, so picture this. You're thinking about buying a food truck business.
Okay, I'm hungry already. Let's do this.
The enterprise value is basically the total cost of everything. The truck itself, all the equipment, the ingredients, any debt the business has, you name it.
Okay, so like all-in costs. Got it.
Now, free cash flow is the money the food truck makes after paying for all the running costs, gas, supplies, all that good stuff.
Like the actual profit they're pocketing.
Exactly.
Yeah.
So let's say this food truck costs $50,000 to buy outright. and it rakes in $5,000 in free cash flow each year. Its enterprise value to free cash flow multiple would be 10.
Okay, I think I'm following. So it would take 10 years of profit to earn back the initial investment.
You got it. And a higher multiple, like Zoom's 12, means investors still believe in the company's potential to make money in the future, even if things seem a bit wobbly right now.
So there's a glimmer of hope there. It's like investors are saying, okay, things are slowing down, but we think Zoom can still turn it around.
Exactly. And that's kind of reflected in Mark Murphy's analysis, too. Even with the stock dip, he's neutral on Zoom, giving it a price target of $80.
Interesting. So it's not quite a eulogy for Zoom just yet, more like the market's waiting to see what their next move is.
Totally. It's like they went from being the prom king to someone who maybe peaked in high school, but might still have some potential.
Huh. Perfect analogy. So what's the big takeaway for our listeners here? What have we learned from Zoom's little roller coaster ride?
I think the main lesson is that the tech world is a fickle beast. Today's superstar can easily become tomorrow's old news.
Truth. Even companies that seem unstoppable can hit a rough patch.
So the big question now is, what will Zoom do next? Can they innovate, adapt, and win back the confidence of those skeptical investors? Will they double down on video conferencing or branch out into something new?
Maybe they'll go all in on virtual reality meetings or those hologram things from Star Wars. Who knows?
Yeah, or maybe they'll become the go-to platform for online learning or virtual events.
Hmm.
The possibilities are kind of endless, really.
The tech world is their oyster.
That's for sure.
Ah.
This is definitely a story we'll be keeping an eye on. So to all our listeners out there, stay tuned. The next chapter in the Zoom saga is just beginning.
And it's bound to be interesting.
That's all the time we have for today's deep dive, but we'll be back soon with more stories from the world of tech.
Until then, stay curious.
And keep on learning.
See you folks later.
Bye, everybody.